I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy.
I think a lot of people are commenting on the fact that the only other 2 times where we've had a 50 basis point rate cut in modern history, it has been just before a recession.
The U.S. Federal Reserve's decision to cut rates by 50 basis points for the first time in over 4 years is raising fears of an impending recession for the world's largest economy. Experts have observed that the central bank has initiated a rate-cutting cycle with a 50 basis point cut only thrice in history. During the dot-com crisis in 2001, the Great Financial Crisis in 2007, and the COVID-19 pandemic in 2020. These were all during severe situations that were followed by severe economic declines, and many believe the Fed's decision to start with a 50 basis point cut, despite the official assurance that all is well with the economy, signals that serious problems lie ahead for the U.S. economy. According to billionaire investor and entrepreneur Chamath Palihapitiya and billionaire venture capitalist David Sachs, the Fed's decision to start with a 50 basis point cut instead of a 0.25% cut like the market expected means the central bank is expecting some troubling times ahead. Both billionaire besties warn that Powell and other FOMC officials are already in panic mode. However, they are trying hard to maintain a sense of calm and normalcy so the entire economy does not go up in flames. Chamath and Sachs believe the Fed will announce further rate cuts before the year ends and commence a full printing cycle when full panic sets in next year. Real Vision founder and CEO Raoul Pal is certain of more cowbell, as he describes the Fed's quantitative easing and money printing cycles starting in about 10 weeks. A recent post he made on social media platform X reads, "I love the smell of more cowbell in the morning. The everything code is in full play, and this is around the 3rd inning. Remember, markets lag global liquidity by 10 weeks. The new China stimulus doesn't even appear on the chart yet, so this was prior to today's announcement." In the latest episode of the All In podcast, Chamath and Sachs share their views on the Fed's 50 basis points and what it means for the U.S. economy in the coming weeks and months.
Is this similar to the dot-com great financial crisis or similar to 2020?
Well, I think 2020, you have to put it a big asterisk, because the question is what would have happened had there not been COVID and had there not been an entire global shutdown. So if you go back to that chart, you could probably just extrapolate and cut out that part that's flat, because the part that's flat from 2020 to 2022 was largely artificially created, because on top of that, we injected so much money into the economy. The reality is we probably would have raised at some rate of change that you could have predicted from 2016. So what do you take away from that? I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy. We have not seen that flow through in earnings or in how companies describe markets on the field, by and large, except for a few. So I think this part of the cycle now will be about all of these companies telling us whether there's nothing to see here or whether there is actual real pressure. And if there is real pressure, it'll probably look like the several times before, where you're just going to have to contract the value of financial assets because they're just not worth as much when they're earning less.
I think a lot of people are commenting on the fact that the only other two times where we've had a 50 basis point rate cut in modern history, it has been just before a recession. So I think this happened in 2001, 2007, right before the recession. And the Fed had to do a dramatic rate cut because they could see in the data that things were weakening. So a lot of people are asking the question, well, is that what's going on here? Now, Powell's comments, though, are indicating that the economy is in good shape. He said the economy is in very good shape, that basically indicating that they had tamed inflation and that they would look to cut another 50 basis points this year. So Powell's rhetoric is, in a way, at odds with the magnitude of this cut. So why didn't they just cut 25 basis points? I think people are trying to figure that out. Yeah, if the economy's hot, why wouldn't you tiptoe into rate cuts and just do 25 now?
That's the key thing. If you look at the dot plot, and if you look at where the smart financial actors are betting where rates end, so it's hard to sort of like look at any point in time, 50 now, 25 later. What does it all mean? It's very hard to know. But what is much clearer is where do we think terminal rates will be even in the next 18 months? And it is dramatically lower from where they are now. And I think that supports, Sachs, that argument that you just made, which is if you're going to basically cut this aggressively over the next year to year and a half, by the estimates of very smart financial actors whose job it is to spend every day observing the Fed, then they must see something. Because otherwise, as you said, you could take a much more gradual approach.
According to Raoul Pal, it's not exactly a matter of the Fed seeing something, but a matter of what they've known all along, and an agreement all central banks had in the aftermath of the great financial crisis, which was to keep printing periodically to prop up their respective economies and prevent the all-out collapse that should have taken down the entire financial system during the crisis. This is the first part of Powell's Everything Code thesis, which he has been talking about for years, and has so far shown an insane correlation to central banks' actions. Last year, when others were calling for a global recession, Powell maintained that it would simply not be allowed to happen because central banks would step in just before things get too bad. He continues to maintain that belief, noting that the Fed and other central banks will have to cut even further in the coming months in accordance with the 2008 agreement and to enable them to service their huge debts. A tweet he made after the Fed's announcement last week reads, "All the hot takes on the Fed seem to forget that the real Fed funds rate is just way too high for the current economy and too high to erode the debt."
And so I think that the smart financial actors are guessing recession or guessing contraction. I think what they're also guessing is similar to non-farm payrolls. We're going to go through a couple of difficult GDP revisions, probably downward. And I think that will have an impact to people's sense of how the economy is doing, even more than what their sense is today, which is already teetering on it's at best okay. And I think all of that has to play itself out. So it's going to be a very complicated and dynamic fall in that respect.
Just in terms of the labor market, what do you see, in companies right now, hiring, the talent pool, et cetera?
Well, I mean, in tech, things are pretty good. I mean, they're not as absurdly frothy as they were during the bubble of 2020 and 2021, but things are good. You have this huge AI tailwind now, and there's just a ton of investment going into AI. There's a little bit of a tale of two cities going on. If you're in AI, things are really bubbly, and if you're outside AI, they've returned to much more normal levels in terms of valuation and company operations, all that kind of stuff. Just to go back to the state of the economy for a second, the reason why a lot of people were predicting a recession, including me for a while, is that the yield curve inverting has been an almost perfect gauge of whether a recession is coming. It's when basically the Fed raises short-term interest rates above long-term interest rates. Normally, long rates are the ones that should be higher because investors demand a higher rate of return to tie up their money for longer. So something's really off and kind of broken when short rates go above long rates, the yield curve inverts. And it's always been the prelude to a recession. But the recession doesn't come when the yield curve inverts. It usually comes when the yield curve de-inverts. Right. And the reason for that is because the Fed now sees weakness and dramatically cuts the short rates. So in other words, it jacks up the short rates to control inflation. That works. It trickles through the economy cools down, and then the Fed says, oh shit, maybe we've overcorrected. They slam on the brakes and then they cut rates to basically make up for the effect in the economy. So the yield curve has finally de-inverted, and the question is just, do we now get that recession, or did the Fed manage this to a soft landing? I don't think we know. I'm not like calling a recession, but this is the thing that people are concerned about.
Yeah. Well, Sachs, we were talking about AI in the group chat, right?
Yeah. I think it's now becoming really clear that call centers are going to be the first really big disruption caused by AI.
Yeah.
I mean, all the level 1 customer support is going to get replaced by AI. I mean, LLMs plus voice, because, OpenAI just released their audio API. You saw that at the All-In Summit, we released a Mearsheimer AI.
Yeah.
Where we trained it on all of his work, and you can go to mearsheimer.ai and ask it questions, and it will tell you the answers in his voice because we cloned his voice using Resemble AI. Anyway, so AI can do voice now, and it can be trained extremely well on large data sets to give you answers to questions, which is pretty much what customer support is. So I think it's now becoming clear that I think within the next 2 to 3 years, you're going to see a massive disruption in that.
Powell is also certain about the disruptive powers of artificial intelligence and how completely disruptive technologies like AI robotics and energy storage will change the world in the coming years. On Tuesday, the Real Vision CEO quoted a tweet that shows a video of OpenAI's Dane Vahey talking about how AI technology has been the greatest cost depreciating technology ever invented. In the video, Vahey explains that the cost per million tokens used for each of OpenAI's models has fallen from 36 to 0.25 in the past 18 months. Powell's tweet, made in reaction to the incredible revelation, reads, "As I've said, AI is a deflationary nuclear bomb. The cheaper it gets, the cheaper everything gets. Electricity is the other one. No one believes it now, but we are reaching the deflationary tipping point there too, which accelerates AI, which accelerates cheaper energy and compute." Powell, in fact, believes this massive acceleration will help solve the world's productivity and massive debt problems. And AI and robotics will provide infinite humans to help improve productivity so we can take on the massive debt burden more easily. He believes this AI renaissance will begin in 2030, completely changing the global economy and markets. That's why Powell says to invest and make as much money as possible before then, because the world will become completely unrecognizable.